Does your business have a line of credit at the bank? Did you know that you could set up your own bank to provide your own business with its line of credit and profit from your own borrowing? In fact, your bank can 1. Accrue tax-free interest earnings on its capital deposits. 2. Collect the interest paid on its line of credit, tax-free. 3. Eventually, pay it all back out to you personally when you retire or sell the business as a tax-deductible deferred compensation or tax-free retirement income for the rest of your life. It's a tax strategy known as business equity banking. It's not actually some sort of federally chartered bank, regulated by the government, or insured by the FDIC, also known as the Federal Deposit Insurance Corporation. It's a private financial instrument, under the Internal Revenue Codes 101 and 7702, insured by a legal reserve insurance company. These tax code provisions allow you to capitalize your bank using retained earnings from your annual profits before your business can begin using your bank as a line of credit. This is not a short-term strategy. You should allow at least 10 to 15 years before you expect to retire or sell the business. However, after capitalizing your bank, the business can borrow up to 90% of your bank's capital and pay it back with interest, just like it is doing right now. Although, and this is key to optimizing the strategy, you don't want the business to pay the minimum interest required. You want the business to pay the maximum interest it can afford. Because interest on a business credit line, used for operational expenditures, is a tax-deductible expense to the business. And these tax-deductible interest payments, along with interest earnings or annual dividends, will accrue tax-free to your bank capital and will eventually get paid out to you personally as either tax-deductible deferred compensation or tax-exempt retirement income. So, the more your business borrows and the more interest it pays on the credit line, the more money there will be available for you when you retire or sell the business. Because, when you sell the business or pass it on to successor management, these tax code provisions allow the corporation to convert your bank capital from a business line of credit into tax-deductible deferred compensation or tax-exempt retirement income, depending on whether you own the bank or the corporation owns the bank. If you capitalize your bank with retained earnings, the corporation will own the bank. So, when you retire or sell the company, the corporation can liquidate the bank and pays out the proceeds to you as deferred compensation, which is a tax-deductible business expense. Now, if you capitalize your business bank with your own share of the profits, you personally will own the bank. And when you retire or sell the business, you can convert the accumulated capital and interest into tax-exempt retirement income for the rest of your life. Interested? Then talk with the financial security professional that asked you to watch this video. One more wealthy answer as we continue creating wealth from life.